Study Provident Fund with Ajaz Sir. Provident Fund. To encourage savings for the social security of employees, the government has set up various kinds of provident funds. The employee contributes a fixed percentage of his salary towards these funds, and in many cases, the employer also contributes. The whole contribution along with interest is credited to the employee's account. He will get paid out of this fund at the time of retirement and at some other important occasions. If the employee dies, his heirs will get the full payment. Let's know more about the various types of Provident Fund. Provident funds are of four kinds. Statutory Provident Fund are the fund to which the Act of 1925 applies, SPF. Recognized Provident Fund, RPF. Unrecognized Provident Fund, URPF. Public Provident Fund, PPF. Statutory Provident Fund. Statutory Provident Fund is the oldest type of fund. This fund was started with a view of promoting savings amongst government employees. Generally, this fund is maintained by government or semi-government departments like Railways, Reserve Bank of India, colleges, universities, local bodies, insurance companies, etc. Statutory Provident Fund, and the amount of interest earned on the accumulated balance to the employee's credit balance is not to be included in the income of the employee, and so it is ignored. When the employee retires or leaves the service and receives any amount from the accumulated balance to his credit in the Statutory Provident Fund, the amount so received will not be included in the employee's total income, Section 10(11) being exempted income. The employee's own contribution will qualify for deduction U.S.A.T.C. Recognized Provident Fund. As the name suggests, it is a fund to which the Commissioner of Income Tax has given the recognition as required under the Income Tax Act. Generally, this fund is maintained by industrial undertakings, business houses, banks, etc. The employer's contribution over and above 12% of the employee's salary will be included in the employee's salary income for tax purposes. The employee's contribution towards this fund will fully qualify for deduction U.S.A.T.C. Interest on Provident Fund credit balance up to the prescribed rate, 9.5%, is exempted, but interest credited over and above such rate is deemed to be the employee's salary income and is included in the salary income of that previous year. Unrecognized Provident Fund. It is the Provident Fund that is not recognized by the Commissioner of Income Tax. The employee and the employer both contribute towards this fund. The employee's contribution is added to the salary, if net salary, or salary after deduction is given, and he will not be allowed any deduction U.S.A.T.C. regarding this contribution while computing the total income of the employee. Payment from this fund is taxable so far it represents the employer's contribution and interest thereon. The employee is entitled to relief under Section 89(1). The employee's contribution is ignored because it was taxed when it was contributed. Interest on the employee's own contribution will be taxable as income from other sources and not as salary income. Public Provident Fund. So far all these funds have been for the salaried people. On July 1, 1968, a new fund known as the Public Provident Fund was started so that self-employed people may also enjoy the benefit of deduction U.S.A.T.C. Self-employed people are doctors, lawyers, accountants, actors, traders, and pensioners. This fund can suit all types of pockets and its working is also very simple. Interested people can open their accounts in the State Bank of India and its subsidiaries. The subscription can be between 500 rupees and 150,000 rupees in 1 year. At one time one can deposit in multiples of 50 and in 1 month only one deposit is possible in the year. Minimum subscription should be 500 rupees and the maximum 150,000 rupees. The full withdrawal is possible after 15 years, but in case of the death of the subscriber, full repayment will be made to the legal heir of the nominee. Partial withdrawal and loans are also possible. The subscription towards this type of fund is eligible for deduction similarly, as in the case of a statutory provident fund. Interest credited to this account is fully exempted. Balances in the Public Provident Fund are not liable to attachment by any court. Thanks for watching. Subscribe to our YouTube channel, Study with Ajaz Sir, to learn more interesting things with fun.